Hey there, Pat Strubbe, founder of Preservation Specialists, with my monthly video. And as you might imagine, there's a lot to keep up with when trying to follow the world of finance and markets. Our team uses a number of different methods to stay informed, and recently, two of our preferred methods meshed together beautifully. Let me share a little more about that. While reviewing a recent article, I came across this chart. What it does is it shows the last 8 times that the yield curve inverted, it was followed by a recession. Now, if you read yield curve inverted and said, huh? I'm sure you're not alone. Let me explain a little more. A yield curve inversion is a fancy way of saying that the rate of return on bonds has flipped and is the opposite of normal. And normally you'd think that the longer you're willing to invest your bonds, the higher the interest rate would be. Makes sense, right? Works the same way with bank CDs. You get more typically for a 2-year CD than a 6-month CD. Normally that is right, but an inversion is when everything is backwards. So with the yield curve inversion, you earn higher rates on shorter term bonds. It's really very weird, isn't it? So what could cause this? I suspect an entire class could be taught on this entire topic, and I don't pretend to be the biggest expert, but I think of it this way. If investors are willing to take less and less return to lock up their money for a longer and longer amount of time, that tells us they're worried about having that money somewhere riskier, like the stock market. Which brings me all the way back to my first point, two methods meshing together. When I saw the chart above, I immediately remembered sitting in a conference in Atlanta a number of years ago listening to an economic guru. He stated that everyone has all kinds of ways to predict the stock market, but he believed that there was only a single one that's proven to be consistently true, and that is that the stock market drops have historically followed a yield curve inversion. So, what exactly is this chart saying? It's showing that the yield curve as of June was more inverted or more unlike normal than each of the last 8 times it's happened since 1969. Now, of course, that doesn't guarantee anything, but if we believe this theory, what does it mean? It means that the likelihood of a recession before the end of this year or sometime next year is increased, and that means there may be some kind of stock market risk that could be increased as well. If you've been watching my videos for a while, you know I don't pretend to be able to predict the stock market, but to me, seeing charts like this are just another reason why having such a diverse allocation for your nest egg is so vital. Part of a successful retirement plan is finding ways to avoid losses on your nest egg as much as possible. By divvying up your nest egg into many different baskets, you're doing what you can to protect yourself from large losses. So regardless of what the financial media is shouting at you today, as long as you're diversified, don't sweat it. We'll stick to your plan and stay focused on helping you accomplish your retirement goals and dreams.